Good afternoon. This is Dennis Wells. Wanted to come to you and share this market analysis, COVID-19 and the real estate market. We want to really answer four key questions that you need to know. Really put this together for real estate professionals. If you're a realtor, you want to be able to be educated, be able to give good advice to your clients and those you're working with. If you're a homeowner, obviously this is of interest to you as we think about the housing market, what your house is worth right now, and what the result and the effect of Corona will do on that. And then also, if you are in the market to buy a house now, next 6 months, next 12 months, you need to understand what's going on and what that is going to mean for you buying a house as we move forward. There are four key questions, like I mentioned earlier. Number one is, will this be a repeat of the 2008 housing crash? And really to answer that, we need to look at the differences between our situation now and that we faced in 2008. Excuse me, in 2008, the mortgage credit availability index was at an all-time high, meaning that you didn't really need a whole lot to get a loan. They were giving mortgages to people that had no income, that had no credit, that had an incredible amount of debt. The subprime market was very big. Basically, if you could breathe, you could get a mortgage. Well, obviously, after the crash, lenders instituted some sane underwriting requirements that now mean that people that can't afford to buy a house, that should be buying a house, can. But there's a lot of those subprime borrowers that just are unable to buy, which has made the housing market strong for the last 10 years. Also, the next thing we need to look at is the annual price appreciation prior to the crash and currently. Obviously, prior to the crash, housing prices went up substantially because there was a lot of money flowing into the real estate market. Because there was more money and there were a limited supply of houses, the price of houses went up, created a bubble, and then housing values fell. Currently, over the last 6 years, housing prices have increased steadily, not near to the extent that they did before the crash. But now the resulting home appreciation is really because not because there's more money flowing into the housing market through the subprime mortgages and things like that, but really because the number of houses available for the people that want to buy houses, they're just less. So it pushes up the price of the house, but they're still more in line with the historical 3% appreciation year over year. Next thing we need to look up is the month of inventory for homes for sale. Generally, 6 months is a balanced market. If you have a 6 months inventory, you have roughly equal numbers of sellers and buyers. Prior to the crash, there was 8.2 months of inventory, meaning there were more houses available than there were people looking to buy them, which is part of the reason why there was a crash. As long as there were plenty of buyers for the houses that were out there, then the market could continue to grow. But once that market started to pull back, that's when we had problems. Today, unlike 2007, today there's 3.1 months of inventory, meaning that you have way more buyers than you have sellers. So if you own your own home, you can be assured that your house is still increasing in value because there are less houses available than there are people that are looking to buy them. And then also what we found in 2005, 6, and 7, people were using their homes as an ATM. They were taking cash out, sometimes up to 125% of what the house was worth. So they were taking out more than the equity that was in their homes to fund trips and buy boats and recreational vehicles and those kinds of things. However, in the last 3 years, the amount of money being cashed out of homes is substantially less. We went from $824 billion in 2005, 6, and 7 to $232 billion in 17, 18, and 19. Meaning that homeowners have a lot of equity in their home right now. So we're in a situation where housing values are strong because people have a lot of worth in their house. Also, what you need to look at is what is the percentage of someone's income that they need to purchase a median price home. So basically, the average income, not the high earners, not the very low earners, but those who are in the middle, to buy a medium price house, which is, not the most expensive, not the least expensive. What they found is prior to the crash, it took, over a quarter of someone's income to afford that mortgage, whereas today it's less than 15%. So, even with a little bit of shrinking in the economy right now because of the COVID-19 virus and the response that we have had to adapt, it's still taking less of someone's income to afford the mortgage, meaning it's more affordable today than ever before. The second question is, how has the housing market been impacted by previous stock market crashes? Many people are looking at their portfolios and realizing that the stocks have taken a beating over the last couple of weeks. What does that mean for housing values and the housing market? Because we remember in 2007, 8, and 9, the S&P dropped 51%. And the annual home depreciation we saw there as well, 4.6 in 2007, 10% in 08, 4% in 09. And so it's normal to think of, we see a stock market crash, we immediately think that home values are going to crater as well. However, when we look historically, there have been other reasons for the stock market to crash. And we can see the effect that had on housing markets. In 2000 to 2002, we had the 9/11 terrorist attacks and the dot-com bubble that burst. During that time period, the S&P went down 45%. At the same time, however, housing prices went up 8.6% in 2000, 6.6% in 2001, 8.5% in 2002. And I've talked with realtors that were in the business at that time, and they said, really, that stock market correction corresponded to an increase in home values. So just because the stock market has gone down does not mean that housing values have gone down. In fact, here's what the experts are saying. What 9/11 has in common with what is happening today is that the shock has also generated fear, angst, and anxiety among the general public. People avoided crowds then as they believed another terrorist attack was coming, and they are acting in the same way today to avoid being sick. The same parts of the economy are under pressure: airlines, leisure, hospitality, restaurants, entertainment, consumer discretionary services in general. So yes, there are parts of our economy that are suffering. The restaurants, entertainment, airline, leisure, those things that you like to do when you can, but your life does not depend on being able to go to Disney World or to go out to eat. Those are the industries and the part of our economy that's being tremendously affected, which is we do feel for those that are involved in those industries, but that does not directly impact the housing market. The third question is, does a recession equal a housing crisis? Many economists now think that we are in a recession, or that we're going to have a recession, because of the effects of the coronavirus and so much of our economy shutting down. When we hear the word recession, we immediately think of 2008, because that is the last recession that we had. However, recession simply means a slowdown. It simply means that the economy is not moving as fast as it was before. Money is not trading hands as fast. Does a recession equal a housing crisis? No. With the sudden economic stop and with many states shutting down by closing down schools, bars, and restaurants, according to Bill McBride, his view is that the U.S. economy is now in a recession starting this month, March 2020, and GDP will decline sharply in Q2. As Goldman Sachs is forecasting, the length of the recession will depend on the course of the pandemic. So what we're finding is, yes, we have an economic slowdown, but it doesn't mean that it's going to be as severe and last as long as it did in 2008. In fact, here's what Goldman Sachs was talking about. They predict that the gross domestic product will fall severely in quarter 2. However, they believe in strong gains coming forward in the end of 2020, going into 2021. The difference between 2008 and now is the difference really between a tornado and a blizzard. A tornado comes through town and literally destroys everything. So part of what needs to happen after a tornado is you have to rebuild things and get things up and running. Whereas a blizzard comes in and shuts everything down for a few days because of the vast amount of snow. But once the snow melts, everything is still there, ready to get up and running. And that's really where we are. In fact, Wells Fargo's Investment Institute says we do not expect a repeat of the severe recession of 2008 and 2009 because the virus and oil shocks are not endemic to the financial systems, but are rather external. Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarters of the year and especially into 2021. Another great graph that shows the effect of home prices because of recession is this, right? That other than the last recession that took place in 2008 that was caused by the housing industry, we find that the other recessions, housing did very well. Yes, in 1991, housing went down a little bit, but in 2001, in 1981 and 1980, housing values actually went up. So just because there's a recession does not mean that the housing values are automatically going to go down. In fact, we find in recessions that housing prices stay very strong. The next question that people have is, will we see a rise in the number of foreclosures because of COVID-19? And it's natural when we think of recessions because of 2008 to think of foreclosures on every street. However, this is what we have found now. The government is stepping in and the government is providing reassurances to homeowners that they will not face the same problems that they had in 2008. In fact, we're told the Federal Housing Administration indicated it's enacting an immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for the next 60 days. FHA announced that it is directing, the Federal Housing Finance Agency rather announced it's directing Fannie Mae and Freddie Mac to suspend foreclosures and evictions for at least 60 days. Now it looks like it's going to be at least a year. I would encourage people, if they can make their mortgage payments, to do so, even though it will not negatively affect your credit if you skip those payments, by talking with your servicer. If you can make your payments, do, because that's just going to put you in a better position if you're looking to buy or refinance down the road. Again, we showed this slide before, but another reason why we're not going to see foreclosures is the amount of value that people have in their homes. If they get to the point where they cannot afford their mortgages, they can sell their home and take the equity in cash and then use that to put down on a smaller house and potentially have an emergency fund that would see them through this short-term crisis. And again, payment as a percentage of income historically is at 21.2%. Right now we are at about 14.8. So as you've seen, there are these 4 questions that people have. we don't want to see an economic shutdown. We don't want to see the problems that we've had with COVID-19. Excuse me. However, we're finding that there's no need to be concerned. The housing market is strong. There's not going to be the foreclosures. Housing prices are going to continue to increase. This isn't 2008 all over again. And the type of challenges that we're facing are not endemic to our housing market, but rather they're outside of our housing market. Now, if you are a real estate professional, I would encourage you to sign up with Keeping Current Matters. All of these slides that I've shown you today come directly from them. They really have their finger on the pulse of the real estate market. And they provide great content, great graphics for you to share with your clients, and give them great advice and help them make really good decisions. If you'd like to try KCM and get a free gift card, go to the link that's provided there. I believe it's a $25 gift card they will give you for signing up, and it's a month-to-month obligation. But I guarantee that if you do sign up, that you're going to find what they have there valuable, and it'll be worth your time to get that. Also, if you'd like more information on the subject, you can also go to keepingcurrentmatters.com/coronavirus. They have these slides there. Also, if you would like to send me an email or post a link in Facebook, we can send you the slides that we provided here today as well. And then also Wells Funding, we want to be your local lender of choice. We provide in-house underwriting, a dedicated service team. We have a local appraisal panel, and we help realtors create and convert leads, and we help buyers make sure that you win the offer, or have the best chance to win the offer working with us compared to working with anyone else. And we do have a full product line. There's really nothing out there that's being done that we can't do, and do that very well. I appreciate your time today. Hope that you have a wonderful afternoon, and we look forward to talking with you soon. If there's anything that we can ever do to help you, please feel free to reach out to us at any time. Thank you so much. Have a great day.